Brazilian economy continues to recover better than expected. We again revised up our forecast for GDP growth for this year from 5.2 to 5.5. Not only because the world economy is growing better, but also because domestic economy is being more resilient to the COVID crisis. Also, inflationary pressures are increasing. We revised up our IPCA forecast for this year from 6.4 to 6.6. Under this environment, the central bank will continue to hike interest rates. We believe that they will hike 100 basis points in the coming Copom meeting, and at the end of the cycle, the Selic will reach 6.75. Finally, despite recent volatility in the markets, we believe that the exchange rate will come back to 4.9, which is our forecast for this year and next year.
During the last month, seems to be corroborating our long-standing call that the U.S. economy will grow very fast in 2021, but most likely not as fast as most people in the market expect. That means that our 5.7% year-over-year forecast for 2021 is looking increasingly probable, and numbers in the neighborhood of 7% now seem to be more difficult, or they will be more difficult to comply with. The reason for this is the performance of the economy during the second quarter, which the economy grew much less than the market expected. The full reason behind the lower than expected growth was the performance of investment. Investment fell, in large part because inventories fell, and those inventories fell because of the continued problems that the supply chains are having around the world, basically cars and boats, etc., because there's not enough microchips, for example, to produce the amount of cars that are needed. So that's why the economy grew less. But anyway, it doesn't matter. Some of that will normalize, but the reality is that 7% growth is looking increasingly complicated. Also last month, the authorities reported inflation numbers that came a little bit better than expected. I'm talking about the core PCE number, which is the most relevant one. Core PCE increased 0.45 month over month in June, and that's an important number because it corroborates the view from the Fed that most of the inflationary pressures that are taking place at this point in time can be tied to the reopening story, and therefore they should be relatively transitory. So we still expect inflation to start falling from current levels and to be below 2%, I'm talking about core PCE, by the end of 2022. Last monthly period was a very difficult one for the Chinese equity markets on the back of the different decisions that the government took against some sectors of the economy, not least the education sector, the virtual education sector in China. Basically, what happened was that the government decided to crack down on many of these industries. For example, the government now wants the virtual education sector to be a non-profit sector because of social issues. Obviously, this is very bad news for the markets, and the markets therefore lost a fair amount of value. At some point, the markets were down 10% on the month because of these different decisions. The main issue with the Chinese government and this virtual education sector has to do with the view from the government that families are spending too much money on extracurricular activities for their kids, and because they're spending so much money, then that reduces the willingness to have more kids. And China has now become very, very concerned about the size of the population. Basically, there are not enough kids in China, and therefore the population is shrinking. So that's why the government recently changed the rules and now will allow families to have up to 3 kids. But again, because of the difficulties and the competition that exists in China between youngsters, etc., then the government now feels that if kids have to go through this additional private sector lectures in the afternoons, then families are going to be negatively affected, and this will be a social problem for them. Think differently from the Chinese, so it is difficult to understand how this happened. But again, we still do not think that this is a change in the view from the government. We still think that China will remain a capitalist, state capitalist country where companies will be allowed to make money, and therefore we don't think investors should overreact to what just happened.
In the Eurozone, the ECB kept interest rates unchanged at its July meeting as expected, but decided to revise its forward guidance after the publication of its new strategy of targeting 2% inflation on a symmetric basis earlier that month. We believe that the new language coming out of the ECB is consistent with our expectation of rates unchanged until at least 2024. The ECB also decided to keep its asset purchase strategy unchanged, and President Lagarde mentioned that tapering discussion at this time was totally premature. Even though we think the ECB will still taper its PEP program by year-end, it will likely increase its regular APP program going forward. Inflation exceeded 2% target in July, as expected, but mostly due to transitory factors that we had anticipated since last year. We still expect inflation to end above target this year, but to fall materially below 2% at the start of 2022. However, we believe that the Eurozone growth will surprise to the upside this year despite the risks associated to the Delta variant, thanks to the ability that the region has shown to vaccinate faster than initial expectations. Second quarter sequential GDP growth of 2%, above consensus of 1.5%, support our long-standing above consensus 5% projection for this year. In Mexico, Banxico surprised markets with a quarter-point hike at its June meeting and left the doors open for more tightening. However, the decision was not unanimous, with 2 board members voting for no hike. Inflation has consistently exceeded expectations in recent months, and the staff increased again its estimated path of future headline and core inflation, which also shows a delay in the convergence to the 3% target. Furthermore, inflation continued to surprise to the upside after the July Banxico meeting. As a result, we expect another 25 basis point hike at the August meeting. However, recent economic data such as GDP in the second quarter, auto sales and bank credit dynamics up to July, and construction sector output support our expectation of a slow recovery in domestic demand, and one that could begin showing up more clearly in inflation figures later this quarter. This behavior is behind our estimation of less aggressive rate hikes for an end-of-year rate of 4.5%, with a bias towards 4.75%. In Colombia, the central bank kept its policy rate at 1.75% at its July meeting, but took an additional shift towards a more hawkish stance, which started in the June meeting, both in line with our expectation. The decision was not unanimous, with 2 board members voting for a hike, while all of them agreed that the space to keep the current level of monetary stimulus is narrowing, given the recent upward behavior of inflation and the staff's upward revision of its 2021 GDP growth projection to match our 7.5% long-standing forecast. As a result, we now expect liftoff to begin in September and an end-of-year policy rate of 2.5% compared to 2.25% before. In the fiscal front, the government presented its much-awaited tax reform bill, which is pretty much in line with our expectation. Overall, we think it is a very realistic bill, and we see a high chance of it being approved without major changes, but more fiscal adjustments will be needed in the short term. Finally, in Chile, the central bank began liftoff by hiking 25 basis points in July, but signaled a dovish normalization process by estimating a gradual hiking cycle and a policy rate below neutral during the 2-year policy horizon. The recent large increase in consumption boosting measures was behind the earlier than expected normalization of monetary policy. However, we reckon that these measures are transitory in nature, and the central bank still thinks that the economy will remain relatively weak for some time. Therefore, we made a slight adjustment to our policy rate forecast to 1.5% by year-end compared to 1.25% before, and we now expect consecutive hikes until it reaches 3.25% next year. However, we warn about the risk of an even looser fiscal policy that could take place in the next few weeks, with a possible extension of the IFE program, as well as the result of the new constitution next year, which could force the central bank to accelerate its tightening cycle and take its policy rate towards 4% in 2022.